History rarely announces itself in real time. Only in hindsight do its contours emerge, isolated moments suddenly connecting like stars in a constellation, revealing a pattern too vast to see up close. But sometimes, if you're paying attention, you can sense the pivot point, the moment when one path diverges into another. Right now, we are standing at such a crossroads. The decisions being made today have the power to completely reshape the global monetary order, and the signs suggest the course may have already been set. If you're passionate about precious metals and how they shape and are shaped by the global economy, you're in the right place. Subscribing helps us keep bringing you the deeper stories behind the headlines, and it truly makes a difference. Thanks for being part of it. If you've been following the headlines, you already know the United States just lit the fuse on a new wave of global tariffs, triggering what many are calling the start of a full-blown trade war. The initial announcement, made with near triumphal fanfare on April 2nd and branded Liberation Day by the administration, landed with a thud once markets grasped the details. Tariffs were steeper than expected, and the market didn't take long to react. Before long, panic had set in. This kind of geopolitical shock often unfolds in two phases. The first is a broad, indiscriminate sell-off, what traders call a flight to safety. Virtually everything took a hit. Gold, silver, oil, equities, the dollar, crypto, copper, you name it. Even treasury yields plunged, signaling that investors were piling into government bonds in search of shelter. But here's the thing. That's just the opening move. What comes next is far more revealing and far more important for gold. And amid the chaos, one detail stood out. Gold didn't fall nearly as hard as everything else, and that's not a coincidence. In moments of extreme volatility, even safe haven assets like gold often see a brief dip as investors liquidate whatever they can. But gold has a unique role. It's both a liquid asset and a long-standing refuge in times of geopolitical and economic stress. That dual identity gives it staying power when other assets are buckling. But there was another critical factor. A carve-out in the new tariffs exempted both gold and silver, signaling that even amid a protectionist surge, these metals are being treated differently, perhaps even strategically. As the dust began to settle, we entered a second phase, reallocation. Here's where the shift became undeniable. Gold began to surge, breaking through to new all-time highs as capital rotated aggressively into metal-backed assets. Meanwhile, treasuries, long viewed as the ultimate risk-free asset, started to see outflows. Investors are beginning to ask a dangerous question. If the US is willing to weaponize its economy, can its debt still be considered a safe haven? We've been covering de-dollarization for a long time, and what was once a fringe concern is now breaking into the mainstream, and the latest events have thrown fuel on the fire. The recent tariff shock didn't just rattle markets, it cracked something deeper: confidence in the US dollar. That crack is widening. We are now witnessing a tangible flight from the dollar. As a share of global foreign reserves, the dollar has dropped from 66% in 2016 to just 57% today. In the past year alone, it has lost 10% of its value relative to a basket of major currencies. And, perhaps most telling of all, the yield on 30-year US Treasuries just jumped from 4.4% to 4.8% in a single week. One of the most dramatic moves since the 1980s, which indicated a sell-off in government bonds. These are not random data points. Together they tell a clear story. Global confidence in the dollar is eroding, and when confidence fades, usage declines. What we're seeing now may not just be a continuation of de-dollarization, it may be an acceleration. The US dollar isn't just America's currency, it's the foundation of the global financial system. As the world's reserve currency, it's the medium through which most international trade is conducted. When two countries do business in dollars, they avoid the mess of exchange rate volatility, currency instability, or liquidity shortfalls. It simplifies trade and reduces friction. That's what has made the dollar indispensable. But the benefits don't stop at international commerce. This global demand for dollars allows the United States to borrow at extraordinary scale and low cost. U.S. Treasuries, debt instruments backed by the federal government, are seen as virtually risk-free precisely because they're backed by the full faith and liquidity of the world's reserve currency. This has allowed us to run large deficits without paying the kind of interest that would cripple other nations. Over time, treasuries became more than just government debt. They became the benchmark. Mortgage rates, corporate bonds, and countless other assets are priced in relation to them. For example, a 10-year treasury yield directly influences the cost of mortgage-backed securities. When demand for treasuries falls, yields rise, and so do mortgage rates. That means de-dollarization isn't just a foreign policy issue. It's a direct line to your monthly payment, your portfolio, and your purchasing power. This is where gold re-enters the picture, not as a speculative play, but as a strategic hedge against systemic risk. If the dollar is no longer seen as unquestionably stable, if treasuries are no longer seen as unquestionably safe, then investors and nations alike begin to look for alternatives. Gold is that alternative. It doesn't depend on a central bank's credibility, it isn't issued by any government, it can't be printed or devalued by political decree, and perhaps most importantly, it has a 5,000-year track record of preserving value in times of currency decline, conflict, and uncertainty. We are already seeing this shift in motion. Central banks have been buying gold at record levels. Individual investors are rotating into metal-backed assets. And as the foundations of the post-war monetary order begin to crack, gold is stepping back into the role it's held for most of human history: real money. Gold's renewed prominence and all-time highs over $3,300 per ounce isn't just a reaction to market volatility, it's a signal. A signal that faith in the current system is weakening and that many are preparing for a world that may no longer revolve around a single reserve currency. That shift isn't guaranteed, but it's a possibility that is now impossible to ignore. We opened by saying history rarely announces itself, but every so often there are moments, crossroads, where the direction we choose can reshape the world for generations. This is one of those moments. No, the dollar hasn't collapsed, the US isn't finished, and gold isn't guaranteed to keep climbing forever. But the signals are there, the cracks are forming. And what comes next depends not just on markets, but on policy, leadership, and how prepared we are, individually and collectively, for the road ahead. There is still time to act, there is still a path to stability. But that path narrows with every short-sighted decision and every missed warning. The future isn't set in stone, but the decisions we make today are laying that foundation. Whether you're an investor, a policymaker, or simply someone trying to protect what you've earned, understanding these shifts isn't about fear. It's about facing reality, seeing clearly, and preparing wisely. And that's all we have for you today. Please remember to like, subscribe, and share with a friend. Thanks for watching, and we'll see you next time.